morning. Yeah, actually we heard a lot about digitalization. I'm a guy actually who tries to implement digitalization. And who of you actually is a seller on the MHSummit platform? Maybe raise your hand. Are there a few? Maybe lately actually you have seen that on the MHSummit platform, you see some things like little buttons and labels here saying forfeit at a certain rate. And as Frank said, actually, we implemented a forfeiting functionality into the MHSummit platform. And now sellers actually who want to put their offers into a tender, they need already the advanced financing of that receivables that later comes up in their calculation to make an offer. So, and this now is possible on the MHSummit platform, and you see that here, and how this all works. I want to give you a little sneak preview how the mechanism works. And maybe you wonder actually why is MHSummit offering now also embedded finance, and why do also other B2B marketplaces offering embedded finance functions directly in a e-commerce platform that normally transacts other core transactions. Well, what do you think actually, if you look at the B2B market, percentage-wise, is already digitalized? You would wonder. Actually, we speak about digitalization already for more than 10, 15 years, but in B2B, the number is quite small. It's just 30%. Well, if you are a buyer, if you buy things, if you buy goods and services, you go on the internet, you go on mobile, and inform yourself about what you want to transact on. So the entire preparation is already digital. But the transactional process from order to payment is mostly analog. But that changes at the moment. 10 years ago, small businesses and then also bigger businesses started to build online shops. Now actually the time of online shops is kind of over. These shops actually are transferred into B2B marketplaces, and there are specific marketplaces for each industry, right? And MHSummit is one of the leading marketplaces in that metal and steel business. And we're very proud actually to be able to cooperate with you guys. So we see a big shift, and all consulting firms and studies actually show that in a few years' time, the transactions will become digitally, whereas the analog ones actually will be the losing parties. Because companies more source via marketplaces. Just have a look at, well, if you leave a little bit the metal and steel market, look at what's going on at Amazon Business. Or we're cooperating with Aon, and I told the guys, well, please connect me to the Word group with the screws and screwdrivers. And they said, well, yeah, we can actually connect you to the Salesforce. No, I want to connect to Vucato. But our friends from Aon actually didn't even know what Vucato was. But Vucato is one of the biggest B2B marketplaces for all tools that craftsmen actually use, right? And there actually the business is sourced. So, and if you do B2B transactions, these B2B transactions do not come only as the core transactions. They are always linked to one kind of trade finance business. So you either need to have got something like a financing, a forfeiting or factoring, or a trade credit insurance because you want to get rid of the payment risk. Or if it is an import-export business, you need to have a letter of credit or guarantee in place. So I think it's worth to have a look at where is trade finance now, and the providers of trade finance, These are normally banks, trade credit insurance partners, and factoring companies. Depends a little bit on the country. In France, actually, factoring is always linked to a bank. In Germany, factoring is mostly done by non-bank providers. And, well, at which stage of digitalization are they? So let's have a look. If you look at the factoring market, if you go to a factoring firm, you have got a weeks, if not months-long process to get an approval, whether you can be financed or not. Credit processes are very high. So then actually talking a lot about the process. When you want to finance a receivable, you want to actually get the cash, and you want to get rid of the receivable out of your balance sheet. Not so easy, because normally in forfeiting and factoring, you always get an advance rate. Just 90% of the receivables will be advanced. 10% is recourse. If you have got recourse, then you can't book the receivable out of your balance sheet. It's very interesting. There's a whole economy of auditors that negotiate with you whether they allow you for the 10% of recourse to book your receivables out of your balance sheet. Cost you $250,000 if you want to do this, right? You always have to offer your entire turnover to that factoring company because they do not like to do single invoice financing. So you have a duty to supply, and you always have, sometimes you even have to arrange a trade credit insurance for the one actually who's financing you. So believe it, look, if you buy a share on the stock exchange and you want to hedge this equity share, you buy yourself a protection, you put option, for instance, right? In the credit markets, it's different. So you want to get financed, you have to buy the hedge for the one actually who finance you. Isn't it insane, right? So also with trade credit insurance, so we have a very oligopolistic market here in Europe. Actually, well, the players are, I think, well known. It's the Tradios, it's Coface, and the biggest one's Allianz Trade. They mostly do wholesale turnover coverage, and if you want to have a cover more than 50,000 euros, there's no automatic decision making, and in your business, everything is above 50,000. It's something actually where they go and make balance sheet analyses and a lot of paperwork that you have to hand in until you actually get credit lines, and these need to be updated on a quarterly basis, if not even monthly, depending on the industry. So, and what's also interesting, trade credit insurance always covers just the case where the debtor goes insolvent. It's not just, well, but sometimes the debtor does not pay just because he's not willing to, but he's not insolvent, right? That's not covered by typical trade credit insurance. And this trade credit insurance is also not transferable. So if you have got a trade credit insurance in place, it's very complex if you afterwards then actually want to do a factoring program and then transfer the receivables to a factor, right? This needs to be in line, and you have to do a lot of contracts, paper-based, wow, right? And with letters of credit, the points listed here, I come to that a little bit later when I tackle a solution for that. So, B2B business very often comes together with trade finance. So, and when the B2B business shifts into a digital fashion, how is trade finance doing, right? So far, it's quite analog. So, let me sum it up a little bit. So, B2B transacted 30%. Currently, trade finance even less. It's around 10% that you can do online. There's just one or two players who really have got an online solution. It's very much people-based. The customer acquisition cost for banks and factoring companies and trade credit insurance is immensely. So they spend a lot of money to acquire you guys, right? And it's all paper-based. So, and I told you in 5 years' time, actually, it's 80% self-servicing, both for the B2B transactions and also for the trade finance stuff that comes along with that. And that shifts actually customer acquisition costs to less than 100 euros, right? We calculated this, believe me. So it's 100% digital. What needs to be in there to make that shift happening are companies like us. So let me put it in, Walbing. So we are an orchestration company. So let me explain you what we're doing. Look please at the bottom of that chart in the middle. We run a few marketplaces. One marketplace is the marketplace for funding. They are funders for receivables, and these are private debt funds, banks, factoring companies that do not want to have got the sourcing costs because they can save the economies of scale of originating. So getting receivables in that world is called originating. So they make use of platforms like us that originate and do risk management for them, so they can just do portfolio management, right? The same we do also on the trade credit insurance market. So we just started that. We partner here with Aon and Munich Re. Munich Re is the biggest reinsurance company, and they also have a primary insurance, which is Great Lakes Insurance. And through Great Lakes Insurance, we put out trade credit insurance, but it works like a syndicate. We put up more and more insurance companies so that if you have a standard policy, insurance policy, it could be that this is backed by, let's say, 30% Munich Re, 40% of Allianz, and 30% of Coface, just as an example. And we run something that we call track and pay, that we do with Lufthansa Industry Solutions, where for all shipments, we put little trackers that have the shape and form of a label, and make sure that we can actually mimic the same economic effect like a letter of credit, but without having the letter of credit or banks involved. I show you how this works later, and this is a marketplace of trackers and shipments. And what we orchestrate, we have got a range of products that I explain you in a moment that we implement in B2B marketplaces. So you see here some example of marketplaces. Not all of them are our customers yet. We have different phases of implementation. But with MetalsHub, we have them. So here we originate the receivables or the risk exposures that then actually go into the marketplaces down there, and are either financed or covered by the institutional investors, right? And subject to certain risk capital solutions. And how that works, actually, I show you later in that presentation. So what kind of products do we have for these marketplaces? We have got Walbing Cash and Bet. This is actually what you see at MetalsHub, right? This is a forfeiting solution where presented receivables will be financed at market rates at real time. When I say market rates, it's the cost for trade receivable is always the funding cost to refinancing for a fund, that is Euribor. It's always time weighted. If you have got a, let's say, a 2 months receivable, 60 days, then actually it's between the 3 months Euribor and 1 month Euribor interpolated. Then you have got risk premiums. You have got two kind of risks involved with trade receivables. One is the payment risk. That's a cost for trade credit insurance. And you have got some risk premium that you might actually have offered a fake invoice, right? Then actually you have got dispute costs, and this dispute cost also makes up a risk premium. Then you have got operational costs, and you have got then also a little profit margin for investors. And this is actually this is actually how institutional investors and banks calculate the price for invoice financing, right, and factoring. And maybe just a little example from the real world. It's not in your business. I haven't seen that yet. But believe it or believe it not, in other industries, businesses actually offer 2 to 3% cash discount to incentivize companies to pay earlier. Do you know actually what 2% cash discounts means as cost of capital if you present this to your client? It's around 20, if it's a 30 days receivable, it's 24%. And 50% of all German companies are offering cash discounts. Can you imagine? If you go to a bank and the bank would ask you, well, we offer you an overdraft line for 24%, what would be your reaction? You would send them away, right? Well, it's really worthwhile to check actually that you always get market rates. If that invoice financing is done at the checkout in order that you want to offer, as a merchant, for instance, companies longer payment terms. Payment terms is very often a differentiating factor to win and keep customers. You can actually offer also installments or trade credit. This product we have here is called Walbing Pay Later. It's kind of a buy now, pay later model that you are used to from Klarna or others in the retail market. It's much more difficult in the B2B market than the retail market. If you do want to shift the risk away at checkout, but you want to use your own liquidity, you can actually use Walbing Pay Guard. Then actually you just have the credit insurance behind. And you have got track and pay. The interesting thing about what we have to offer is that we offer that financing in real time, and we always finance 100% of the receivable. So there is no discussion of whether the receivable can be booked out of your books or not. It always can. Because true sale, that's the technical term for you can put the receivables out of your books, means if 100% of the debt creditor risk is shifted to an investor, the receivable can be booked out of your balance sheet. And this actually works internationally, not only in Germany, right? Same with credit insurance. We do this instantly, right? We have got APIs, and we work with Munich Re with a huge AI model that crawls a lot of data, not only balance sheet data of companies. They have a huge database, and we keep the data flowing. That's why we can offer this in real time. So let me provide you with a view actually how institutional investors look at it and how they manage the money that you need. So what they do is they don't do this face by face or sitting in front of a trading monitor anymore. So if you watch Wall Street and see all the people actually hanging on the phone and crying, and well, I want to get this asset and this asset, this time is over. This is actually all about algorithmic trading. And as such, we also offer something that is called algorithmic factoring with our alpha. And we symbolized our alpha here a little bit. And institutional investors actually look for fixed income streams. They want to actually have their money, and they want to get a fixed income coupon out of their money. And the first thing that they look is capital utilization. Let's say actually they have got a fund, 30, 50 million. Then they want this 30 million invested all the time. They do not want actually that, well, 10 million is invested and 20 million is just lying there in cash. That is not, well, putting capital to work. They really want to maximize that at least 29 point something million is invested all the time, right? So the capital utilization, this is what they look at. Then they have got target yields. Depending on their risk and the risk capitalization, they want to have a risk-adjusted yield on capital. And therefore, they look for certain portfolios, and they know actually what the economic capital is for that portfolio, and they attach a yield, an internal rate of return for that they want to achieve. Then actually they have got some box constraints That means, in technical terms, eligibility criteria. In what kind of receivables are they allowed to invest, and in which receivables are they not allowed to invest? So the usual suspects are, of course, military, pornography, gambling, and all that exciting stuff. They don't do this. This is boring business, right? And then actually they have got some preferences on diversification. They do not want to put all the eggs in just one basket. They want to spread this. And this actually looks like this. I'll give you some overviews. Here they actually set the target returns. That could be just one target return, but could be also target returns for certain risk scores, right? As they see that, we, for instance, work with risk scores from Munich Re to make it compatible with the trade credit insurance. Then actually it's something whether they want to buy receivables always trade credit insurance, also with a hedge, or unhedged, or if a risk limit is available, then with an insurance. Then actually they set their eligibility criteria, and we have got lots of criteria. All debtor information, all seller information, the relationship, so the relationship between seller and debtor, also the payment behavior, that all can be configured and can be made available as criteria. But one of the most important criteria is, of course, a rating. It's a credit insurance rating. The second most important criteria is payment behavior. Why are both needed? Well, let me give you an example. Who is the best, or who has got, which institution in Germany would have got the best credit rating at all? What do you think? The Federal Republic of Germany. Who is the worst payer? The Federal Republic of Germany. So and I've got empirical evidence, meanwhile, with a lot of institutions from the Federal Republic of Germany. You can be sure they pay, but they always pay 180 days late, right? So you can actually do arbitrage with that. And then actually you set also diversification criteria where you actually just say, well, we do not want to put all the money with a debtor in the steel market. Maybe actually we should spread it across some other industries as well, right? So that's about cash and bet. What's about track and pay? Well, the underlying problem in the import and export business is that exporters do not want to ship without getting paid first, and importers do not want to pay without getting shipped first. Too bad, huh? No trade is done. So about more than 100 years ago, there was a financial product invented called letter of credit. So both the exporter and importer go to their banks. They trust each other and guarantee for the performance of the exporter and the payment from the importer. And that costs a lot of money. If you look at the interesting thing, actually, the cost for a letter of credit varies between 1% and 6% of the goods value. And the way actually how banks disguise it is that they invented 20 plus different cost types that all look very small, but if you add them up, actually, they're quite expensive. If you use letters of credit, actually make your controller just recalculate the cost for a letter of credit. That actually has a regression effect. The higher the cost, the goods value, the lower the cost for a letter of credit, to be fair. But the lower the goods value, a letter of credit is extremely expensive, and it takes weeks until you can open it. We have done it differently. Actually, we say, well, the buyer puts if he has got the money, he puts the money on an escrow account. It's still his money, but for a certain period of time, he can't access this money. And then trackers are sent through Lufthansa Industry Solutions to the exporter or to the packaging company of the exporter. then actually the trackers will be linked to our platform. It's like little Apple AirTags, just as a label. And that can measure not only location, but also temperature, lack of shock, humidity, pressure, air pressure, and lots more. And then actually the goods get shipped. And depending actually on what kind of payment plan the two parties agreed on our platform, then payments are triggered from that escrow account to the exporter. No bank involved. And it works within 2 days, right? And to give you a little impression, actually, I have a video for you that shows it. It's a very quick one. Track and Pay makes payments invisible and passive. Thank you very much. I'm happy to take your questions.
Jörg, thank you very much. As I said, we searched long time for the right partner. I always have to say that the marketplace that we run is only a small part of the entire MetalSub ecosystem, with solutions built around it for buyers and sellers. Nevertheless, I think this is a huge opportunity. There's one question that always comes from our suppliers: the costs. And yes, we've just started, and of course, maybe some of your investors are not used yet to commodity transactions where actually the margins are relatively small. So talking about the 24% discount rate that some buyers give or sellers give people, that's not very common in this industry. And unless you fiddle around with the specifications of a certain commodity, your margins are actually relatively small, but you need to have huge transaction volumes in order to make up for that. But look, we are working together on that. What's your solution towards driving down the costs of forfeiting?
Yeah, well, it's always with ramp up that if you have got new players, and first of all, a very small cohort of companies actually trying that out, is and these are first of all unknown to investors, right? And they put because actually they are unknown to the investors, but also the transactions are unknown, and they need to get to know each other a little bit. So they put some risk premiums on top of it. And well, if you compare this, of course, to long-standing bank relations, where some banks of you have gone through with you through thick and thin already, and they know you, they don't take this risk premiums. But these go away from time to time. If you've seen that, actually, the margins actually went down already, and they will constantly do. Also, what we have is when we started, we not yet had so much commodity trade finance investors in place. Now we have, so it works like this as well. And we have got another effect, and this was the biggest effect. Have a look at the yield curves, right? The interest rates has risen tremendously. So normally, when you guys had some credit lines with your banks, then of course they are fixed for a certain period of time. But then they jump up to the market rates immediately. So whereas we then have already the current market rates are a little bit behind that, but the whole thing reverses. When interest rates fall down again, we are then quicker than this. So this actually is something that needs to get to equilibrium. Will be done very, very fast, as capital markets are. And then actually you will see that you always get market rates, and once actually these rate structures stabilizes a little bit, you will actually face that it's a much quicker way to get funding through the MetalSub platform than actually just reaching out to various banks and try to negotiate, then actually the core business might have been gone already.
Thank you. Questions from the audience? I know we have people here from banks, so I was wondering. No? I have another question then. I mean, talking about banks, you said that your investors that actually buy those receivables, so the invoices of the suppliers, they are asset funds, pension funds, etc. You mentioned some banks. You mentioned and you explained a solution that actually replaces or could potentially replace letter of credit. What is the future of banks in all of that?
Well, that's a very interesting question. Well, I think banks actually will always be a facilitator of those solutions. So we cooperate with banks and other banking-like partners to bring these solutions to companies or to marketplaces. So we're not that big organization yet. So we make use of an ecosystem, and our ecosystem consists of different banks. But if you have a look at, I liked your chat about blockchain. We are currently working with another institution. Unfortunately, I can't name this yet. That works with CBDC, so Central Bank Digital Currency. This won't be on the blockchain. This will be a real-time connection between the European Central Bank and companies using a bank account or a digital wallet. And actually, you do not need a commercial bank account anymore with a commercial bank. Because actually the bank account is always synchronized with the ECB. And we're actually integrating this in Track and Pay currently with one of the biggest trust companies out of Munich, and that also made Apple Pay and Google Pay possible. And the banks actually will need to transform. They need to become fintechs. Otherwise, actually, they just can benefit currently from the interest rate developments. But independent from this development, if you look at the balance sheet, it doesn't look that good.
Look, I think that's a fascinating future. I do think that there are going to be probably also banks that are getting involved in all of this more and more, and because one of my friends always said to me, banking is IT these days. And I think we're looking forward to continuing the partnership with you, and so that you get your head around a bit more commodities, also for you, the book, The World for Sales. So thank you very much.
Very exciting.
And I think you are still around here.